I'm Kenji from Tradveller. Today I'm going to talk to you something about quantitative trading, a minor introduction about what is it. So in trading, we have quite a lot of ways to approach in trading. Mainly from the old time until now, we know that we have mainly two types, the fundamental types or technical analysis type. So a fundamental type is like, you rely on some underlying events or data to make a judgment for a long or short. Let's take the example for stock market. So in stock market, usually we will say, if this company, their revenue or their profit is growing, so we should buy the stock of this company because we are targeting that a growing of revenue will increase the stock price. The stock price will increase together. So this is one type of a model in fundamental analysis. Whereas in technical analysis, they are mostly focusing on analyzing the price action. So let's say we have moving average of 50 days. So when the price of stock is above moving average, we take it as long uptrend. And what we should do is we are buying long. So these are the main department of trading methodology. Throughout the times, like the main two departments. So what is quantitative trading? To be exact, quantitative trading is sort of like, in the terms, is actually using mathematical calculations to crunching all the numbers to find patterns in the market so that we can go in and out according to our historical backtest result on data. And the thing is, quantitative trading actually can sort of like work in both the fundamental parts or the methodology department. So let me go further. In quantitative trading, we are taking as much historical data as we can, and then maybe we have some ideas, or maybe we know certain kind of behavior, or we observe certain kind of behavior in this kind of market movement, and then we have a hypothesis or have assumption. Let's say, using back the stock example again, the assumption is that I assume when the profit of a company is increased, the price of their stock should increase. So under this assumption, a quantitative trading way of analyzing is that we will take as much data as we can of all sort of companies, maybe all of their historical earnings as long as we can, and then all of their historical price data, and we are merging them together. And from there, we are looking whether this thing really works, this model, this assumption really works or not. We are using mathematical kind of models, calculations, number crunching, programming, coding to find what is the correlation between revenue and profit of a company and their stock price. If there is a positive correlation, we also will optimize, see how much increase in profit will ensure there will be a high likelihood of the stock price moving up. So from there, we have the assumption, we have the data, we backtest it, we find a correlation. After we get the correlation, we optimize it to know at what threshold, when the factors affecting the price is happening, at what threshold is that happening going to give an effect into the price. And from here, we can have a very clear result of how this thing performs. So this is the benefit when it comes to quantitative trading, because we are testing the history and see how likely this model going to work, how likely this assumption going to work. Sometimes if we are doing manual trade, I have this assumption, I observe maybe a limited amount of example in the markets, and then I start to deploy this strategy, and who knows if it works or not. We don't know, because we have a very limited observation period or attention we can give when we are analyzing in a manual way. One good thing is in quantitative trading is that all of the backtesting can be done by computer, even it's like 10 or 20 years kind of backtesting. So this is an advantage when it comes to quantitative trading. In quantitative trading, as I said just now, we can work in both the fundamental side or the technical side. Technical side is quite straightforward because all price data is numbers. We can just crunch number, like we're using moving average, we're using some sort of percentage, we run some sort of Carlson model, Brownie model for some random kind of thing. So there are so much model out there, we can try to find whether the assumption or the hypothesis that we have works or not. So this is one of the benefit of quantitative trading. It gives a very clear indication of whether our hypothesis is correct or not. If it is correct, at what threshold when they change, we're going to give effect to their prices, and from there we can take our trades. Another very significant characteristic of quantitative trading is that because we are using very precise kind of condition when we are doing our models or we are analyzing our models. So if the models proven to be profitable, which is working, we can convert them into a strategy, and the very, very advantageous part is that this strategy, due to its precise conditions, we can put it into a program. The computer can automatically execute the trade for us. we don't have to monitor the condition when it came and then execute our trade manually. So the computer can do all the things for us. We just have to make sure our model is correct, all the calculation done is correct. We make sure our drawdown doesn't too big. We set our entry sizes to be moderate according to what we have, according to the account size that we have. And thanks to this, where the computer can fully run our strategy by itself, what we can do, what we have to do, or what left to do is monitor the result. If the result is not good, we will pause or maybe stop the strategy for a while and then revise again, see whether is there anything we miss out. Or at the same time, we can develop even more strategy to cover our portfolio performance. Meaning that, let's say we have a strategy which is doing momentum, doing long or doing short only. So if the market is moving sideways, which is quite often the time, most of the time maybe, when the market is moving sideways, we could have another mean reverting strategy taking advantage from there. So with this case, our portfolio performance will be more stable and more consistent, because if a trader is trading manually, usually they have a very limited set of bias, maybe 1 to 2. Either he's doing momentum only or maybe he's doing mean reverting, because it's really hard for them to switching mode unless they are so pro and so good. There are people out there, but that's the minor case, maybe like a unicorn, this kind of minor. And for the general people or the vast population who is coming to trading, doing manual trade, highly likely they're going to have only 1 to 2 set of bias. And in order for them to switching between the bias is really unadvisable sometimes, because they mess up their mind like, oh, what kind of strategy I'm using here. So this is the limitation when a person is trading manually. They could have only a very limited set of bias. They could only trade at a certain period of time of the day, and then they could only observe a very limited amount of markets, since we only got a pair of hands and a pair of eyes. So in quantitative trading, we could develop all sorts of strategy as long as it's proven to be profitable. We can deploy 10, 20, 100 or even 1,000 of them. Imagine you have a portfolio all executing their trade automatically, and all those trades being executed has been back tested and give a very clear indication whether it will work or not. And with all this kind of combination, the return of portfolio will be smoother, very stable. And then what a trader has to do is just monitor the performance. And this is what quantitative is so good and advantageous. And I hope you guys find this useful and take some time to explore what quantitative trading is. Alright, see you guys next time. Ciao, goodbye.